I heard you mention that small caps are probably the last in the pecking order. So what, 2022 is a year small caps underperform large caps by about 5-6%. When I look at it from the lows of June, small caps actually outperform the Nifty by a similar percentage, about 6% odd. So, but aggregate small caps have underperformed. There's a lot of talk about how the Nifty may consolidate, but the broader markets, individual stocks may do their own thing, and therefore the place to be is in smart mid caps and small caps. My question to you is, are you in that camp, or are you, because you're a macro investor, kind of shying away from the aggregate small cap, mid cap space? And if you are into equities, you're parking yourself in the large caps.
Yeah, so let's just look at two sides of small mid caps. One is the balance sheet themselves. They tend to suffer, Neeraj, when liquidity is tight and access to finance or capital is somewhat restricted. And to that extent, these firms have had sort of gala time over the last 2-3 years, especially after 2020. And the water is receding now, and the capital access to them for last few months and incrementally for next many months would be somewhat restrictive. Second is, of course, that they also have lower pricing power, so to say, and to that extent, if the growth run rate, and more specifically, remember, Neeraj, that the nominal growth, which is clocking at about 15-20% right now, is going to halve most probably in next 1 year. So in that setup, actually, small caps tend to suffer. Low inflation for small cap is a sort of a disaster. Good high inflation, actually, small caps, because they tend to operate in a lot of intermediate sectors, they actually benefit from it. So that's the fundamentals of it. I also worry about the flow part of it. So in a sense, look at mutual funds. A large part of money flow to mutual funds has been to small and mid cap. Every month about 1.5% of AUM of mutual fund accretion is happening in small caps. Now, because as we talked about the absence of TINA, a lot of HNI and a lot of retail investors will have an opportunity to go to rates. And to that extent, a 2018-19 flip can play out, Neeraj, in which, in 2019, FY19, when the rates tightened, the MF flows, ex-ETF, actually halved from FY18. So my worry is that MF flows will actually slow. Cyclically, FIs will not be big sellers, given they will not be a big, significant force, but they'll not be big sellers. To that extent, and HNIs will be sort of relatively missing because of the other opportunity, because the TINA is not there. So to that extent, the overall flows could still be about 0.8, 0.9% or 0.7% of GDP, but the flair and the shape of the flows will be different, more dedicated towards what we call large cap, because a lot of small cap investors, the retail ones, will find other opportunities. So my sense is that the overall aggregate flows for small cap will actually dwindle, to a certain extent what happened in FY19. So both on the fundamentals and flow side, our old argument of last 1 year that, once you enter in a weak macro, stay away from small cap. They may give you upar niche, but net outcome, through the cycle will be bad for you. And therefore, if you want to be in equities, hide yourself in large cap only. Small and mid cap, you will see both balance sheets struggling, as well as, flow side of it actually starting to sort of wobble.